Please subscribe, like, and hit that notification bell. Thanks, guys. Hi, everybody. I'll do the intro, Kevin, this time, if you don't mind.
Okay, yeah.
We have Jordan Roy Byrne back on the show. I always love talking to Jordan. He's a no-nonsense TA guy, and he calls it as he sees it. So all you guys calling for $100 gold, you better go hide under a rock because that's not going to happen, according to Jordan. So look, let's start with a hard question. Well, welcome, Jordan. And
Yeah,
I'll
thank you
start.
so much. Thank you so much for having me, guys. It's a pleasure to be on with you again.
Well, I know you look at the big picture stuff. I know you look at the ratio charts, and you have a pretty versatile weight of evidence approach. I see the charts you look at. I inspire myself sometimes of the stuff I see you do, and I say, "Oh, that's cool." And so I like from the horse's mouth there. I want to hear you say that we're not at a 1995 type of situation where stock markets just rip and gold goes down, and then we're in a new melt up. I keep hearing that. So do you have any thoughts on the possibility that we're heading into another 3-4 years of crazy outperformance of stocks versus gold in real terms?
Yeah, it's something I've thought about, quite a bit. I even thought about it. You go back to 2015 and 2016, and at that point, when the initial part of the secular bear in precious metals and things were so badly beaten down. I mean, I was thinking about it then, but yeah, even aside from then, we're 7-8 years past that. I think the main problem with that comparison is that if you look in the 80s and 90s, I mean, the 90s especially, gold was not strong in real terms. I mean, obviously it was performing poorly against the stock market, but there were periods when during that time when the dollar was pretty weak, but gold did not perform that well given that weakness in the dollar. So if you would chart gold against foreign currencies, and one way of looking at that is you can just do gold multiplied by the US dollar index. And what you see in the 80s and 90s is that was actually weaker than just gold in US dollars. So that's a big, I mean, today, gold against foreign currency, I mean, it's been making new all-time highs. It's been leading the whole way. It's been much stronger than gold in dollars. And the reason why that's important is because it's a really good leading indicator for gold. Typically, when gold against foreign currencies makes a new high first and it holds that high for a quarter or two, you will see gold and dollars follow. And so if you go back to the 80s and 90s, gold was so weak against foreign currencies that, I mean, that by itself was a good leading indicator that, we weren't close to the point where gold was going to go into a secular bull. And so that's important to consider. In addition to that, just the gold price action by itself. I mean, we go back 12, 13 years. I mean, gold's in this super bullish base. It's in this super bullish cup and handle. And yes, I mean, the cup was 9 years, the handle is 3 years. And I mean, that's perfectly fine. Even though it's painful for a lot of people, including myself, who've been expecting breakouts at certain points. I mean, in the big picture, it's still perfectly normal. And so the price action for gold holding up so well, it's just a super bullish consolidation. I mean, it's so close to breaking out in the last year or so. That's much different than the price action in the 90s and during that period. So I've definitely thought about it, but I don't see, I just see it as a very remote possibility. And I think if we look at the macro fundamentals, of course, we'll get into the bond market, which appears to be in a new secular bear market. I mean, we're looking at all these things. Everything to me points to the 1960s, mid to late 1960s. That's a much better comparison. The late 90s, I don't see any comparison to that. Anything that's going on in the markets that tell me we're going to repeat that. I just don't see evidence of that. And fundamentally, I just don't see anything in the macro sense that's, we're going to have this big melt up for a couple years. I just think to me, the evidence of that is really low.
So to summarize, I mean, would you kind of say that, or agree with the fact or the statement that gold is really reflecting a loss of purchasing power, and the reduction of purchasing power of global currencies is just simply what gold has and is continuing to price in? So, you know, the fact that we're seeing inflation around the world, not just here in Europe where I live, but in the States and further afield as well. And that inflationary pressure has already caused those currencies to lose purchasing power. And if, you know, for example, your daily groceries are going to cost you more dollars, then it makes absolute sense that, you know, an ounce of gold is going to cost you more dollars. And, you know, that I beg your pardon, that gold is simply going to price in the next wave of purchasing power destruction. I mean, would you agree with that? Is that how you kind of see gold, you know, as a tool, a measure, a barometer of purchasing power destruction?
I think in a very, very long-term sense. I mean, if we're looking at bits and pieces like 5 and 10 year timeframes, it doesn't necessarily perfectly correlate to that. However, that, you know, being an American, I'm focused on gold and the US dollars. But if you look at, if you take away that viewpoint and you're looking at gold and other currencies, that to me, I think makes a lot more sense. But I think in the bigger picture, I mean, the US is the biggest market, and so the most important market, and we've still had this secular bull ongoing in the US stock market. And, you know, the dollar, you know, it hasn't been the best secular bull market, but you could say it's still intact. And I think those things are the reason that why gold hasn't broken out and really run away yet. But I mean, it will soon enough.
It's actually very encouraging, isn't it, that, you know, we've seen significant strength in the US dollar, and the US dollar index has been pushing up to the levels that it has, you know, above 105, 106, 107, and gold hasn't collapsed. Gold hasn't broken down from its cup and handle pattern. It's just continued to build, and here we are sitting remarkably close to all-time highs despite US dollar strength. You know, gold has just recently moved up $200 in the face of that, you know, currency strength for the US dollar. So I tend to agree with you. You know, the fact that that underlying strength is there. You mentioned a moment ago the bond market. So how are you seeing what's going on with bonds at the moment, and with bond yields and all that kind of side of things? What's your take on that?
Well, I mean, at the moment, we're probably getting a counter trend move where bonds got incredibly oversold, and so, you know, and yields overbought. So now we're seeing again a counter trend move in that. But I think if we step back and, you know, look at the big picture, which I know you guys also do, you know, and I've been talking about the 1960s as the best comparison, and it's really interesting because if you look at the mid to late 1960s, I want to say it was 67 or 68. Of course, you had at the end of 68, the secular bear started in U.S. stocks, and the first thing to go, you had a breakout in inflation in 65, and so, you know, depending on if you use total return or you use yields, I mean, there was some point in there, 67, early 68, where the bond market had this breakout where it actually the 10-year yield got above its 1920 peak. So 1920, you had an inflationary peak in 1920, you had one in 1951, but of course, you know, you had QE in the 40s into, I think, 1948 or 49 or somewhere around there. So the 10-year yield had this, it was in this you know, this long base going back to 1920, although in when they let it go in the early 50s, then it started moving higher. But basically, you know, 67, 60, somewhere in there, it went above the 1920 peak, which I think was around 5%, something like that. So that move, that breakout in the bond yield basically led to the secular bear in the stock market. So that, I mean, that preceded everything that happened in the 70s. And so It doesn't mean everything is going to repeat itself exactly the same, but thinking about that, thinking about what's happened in the bond market in the last year or so, and now that it's really hard to say that we're not in a new secular bear market for bonds. I mean, sure, we're probably going to have a recession and bonds could probably have a decent rally, but I mean, that is likely to be a big counter trend move. But aside from that, I mean, it's going to be such a shift over the coming years in that we're not going to be able to just, you know, not jack rates, you know, put rates at 0 or 1%. And, you know, we're going to have all this debt and this borrowing and all that. Like that's not going to be able to happen again. So we're going into a new era where it's going to be fiscal expansion, you know, government spending and all of that, which is more inflationary. So, I mean, I'm just thinking about those larger macro issues. I mean, they're going to be huge drivers for precious metals and hard assets. And so the historical point is that when the bond market finally broke in the late 1960s, and I mean, it's a great demarcation point because you have that, then you had the stock market in 69 or the end of 68 breaking down and going into its secular bear, you know, then that led to, of course, this great bull market in gold and hard assets. And so, and also, you had I think you had 3 waves of inflation from, you know, 64 to 81, 82. And so, I mean, after the first wave, I mean, it wasn't the first wave that really shifted the tide from hard assets and gold really outperforming financial assets. I mean, through the first wave, financial assets in the stock market still did really well. So that, I mean, that's another important thing for people to understand, that the first wave, you know, the market performed well, but it was really the second wave, once that got going, you know, that's what really hurt financial assets in the stock market. And so we've had the first wave up, you know, now we've come down, you know, we're probably going to have a recession at some point. If the stock market goes a lot lower, you know, then it's in position where it'll rebound, it'll move higher in the next expansion. But once inflation really picks up again, that's going to be the point that's really going to color hard assets outperforming the stock market. So not to babble on here about history, but that's the importance of the bond secular bear market. Is if you look at that last cycle, it happened at the end of the first wave of inflation when bonds broke. Then after that, you know, it led to a secular bear in the stock market. You know, and I use the 40-month moving average for the stock market. So that's something I'll be watching, you know, over the next 3, 6, 9 months to see if we do get the recession and then we do get this breakdown in the stock market where it really loses that moving average. So, you know, once that happens, and we know that gold's the leader. So if and when that happens, you know, gold is probably going to fly at the same time. And that's going to be the start of this. Well, I mean, it may have already started, but that's, you know, it's a real early part of this new secular trend, which is, you know, secular bull market in precious metals and hard assets outperforming the stock market. And you know, also the bond market as well. Because if you look at the 2000s, you had the commodity bull market, but you only had a stock bear market then. You didn't have a bond bear market. So that's why the 70s was so powerful, because you had bull market in hard assets, but at the same time, you had a secular bear in stocks and a secular bear in bonds. So, I mean, we're heading into a repeat of that. And so what will happen in hard assets, it's going to be, you know, it's going to be as explosive as it was like in the 70s. And you're going to see some spectacular moves, you know, less so like the 2000s.
Well, it's amazing that, you know, people seem to forget that gold did a 6 times move between 2000 and 2011. And even, you know, just reapplying that kind of, replicating that kind of move from the lows around 1500 gives some numbers that people would, you know, balk at kind of believing. You know, they'd struggle to believe that the kind of figures that results in, $10,000 to $12,000 gold, is, you know, even vaguely possible in the next 5 to 8 years. Yeah, I'm talking about sort of numbers. Do you have a sort of a roadmap in terms of timeline and numbers for gold and silver?
Yeah, it's you know, I'm not a big cycles guy. I'm not a fan of that. But if you look, it's interesting how there's been peaks every 60 years. I mean, every 30 years, but then every 60 years you get a major peak. So 1920 was a major peak. You had 1951, 1980 was a major peak. 2011 was a peak. So I think that based on that, you know, you could see a major peak in the late 2030s or 2040. And so that, you know, that tells us that, you know, precious metals really have a long way to go. And of course, you know, gold is different because it doesn't have, you know, it's not like silver where it also has an industrial component. But yeah, it's definitely something I've thought about, and it's really hard to think. I mean, well, is gold only going to have a 10-year move? Is it going to be a 15-year move? It's really hard to it's hard to say. I mean, it's just we're just guessing, and that it's really hard to know at this point. But I do think minimum move that start a 10-year move. And as far as price levels, if you look at gold against the S&P and, you know, gold against the monetary base and a lot of these you know, data sets, I mean, they're pointing to 20 or 30,000 gold now. And you look at the gold silver ratio. I mean, eventually silver could get to 1,000. And you know, granted, a lot of that will happen. You know, a lot of that move will happen. I mean, those are gold and, you know, that we could potentially see, you know, once we get end of this decade or into the next decade. I mean, it's just based on math and looking at data over the last 150 years. If we look at, you know, if you look at gold against the S&P,
freezing
4
up.
or 5 different times in the last 150 years. And we're looking at it now, so it's, you know, just below 4,400. So I mean, if you take a 5 multiple, S&P doesn't go anywhere for 10 or 12 years. I mean, you're looking, what is that, like 23,000 gold? So
I find that interesting as well.
just,
That people do often turn around and say, well, you know, 20,000 gold, you know, that's going to mean the end of the world. What kind of world are we going to live in? But hang on a minute, it's done that not once before, not twice before, but three or 4 times before. And, you know, we're all still here to talk about it. So this idea that the world is going to stop turning if we have $20,000 gold, to me, is just a complete red herring that doesn't make any kind of sense. And of course, you've got to set that alongside goodness knows what the inflation might happen to be in over the course of the next 10, 15 years. You know, you've got to accumulate all that inflationary effect as well. So, you know, that argument to me is just dead in the water. I don't know what you think about that when people say that. Yeah, I mean, rapidly rising gold does often reflect bad things going on in the world, but it's done that before, reflecting fairly unpleasant things that are going on in the world around us. But it doesn't necessarily mean that it's the end of the world.
right. Yeah, no, I completely agree with you. If you think about the moves we had in the 2000s and also the 70s, I mean, gold being fixed at 35 for so long, and then you think about it went up, you know, 25x basically to almost 900. That was a spectacular move. Yes, it was a bad time, but it wasn't the end of the world. So obviously it's not going to be good. But you know, there will be crazy stuff that happens in, you know, politics and all that other stuff. And yes, we all understand that it's generally not going to be a good time, but it's not the end of the world. I mean, life goes on.
Now, I know behind you it says the Daily Gold, and gold is very much, and precious metals very much your kind of thing. And I don't know if you've been asked this very much, but cryptocurrencies are also an anti-establishment, anti-fiat kind of a proposition, very much like gold and silver. And the followings of, you know, people who follow precious metals and people who follow cryptocurrencies very often seem to diverge very dramatically with people very much, in one camp or the other. It's hard to find people that are actually open-minded enough to say that, well, there's a place for both, and both may well shine, metaphorically speaking. But I mean, how do you have any particular views on, when I say crypto, I suppose particularly Bitcoin, particularly the sort of handful of leading cryptocurrencies, the ones that might actually be around in 5 to 10 years time? Do you have any view on those and what they may be doing over the coming few years?
Yeah, it's really interesting to me because when you look at Bitcoin, it's the move in Bitcoin has mirrored that of the NASDAQ. And so we've been in this secular bull since 2009. Bitcoin got going, I think, in 2011. And you look at the years when Bitcoin has been the strongest, they were some of the absolute best years for the stock market. So Bitcoin and crypto has traded. To me, it's a technology play. It's not a currency play based on how it's traded. And so given that, I tend to think that it's, assuming we get this secular bull in precious metals, I don't think Bitcoin and crypto are going to perform that well. However, I will be interested to see, like, if it can continue to perform well, even if you're in this secular bear for the stock market, while you're in a secular bull for gold and hard assets. So that I just have a hard time seeing. Yes, it performed really well during the secular bull in the stock market and tech stocks, and I mean, how is it going to be able to continue to perform just as well when those assets are in a secular bear? So that's my issue with assuming Bitcoin is going to perform alongside gold and silver. I'm skeptical of that at this point.
Look, Jordan, it shouldn't even be a discussion. It's because people are confusing ideology with price. Like you said, what the aggregate of market participants are defining it as. People are just confused. They go in for the speculation because it went up just like any tech stock, NVIDIA, blah, 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 insert your favorite tech stock. It went up the same way. And then people, to sleep better at night, it's sound money. Oh, it's a blockchain. And they wrap, and then they go in this thing that's non-price. It's price agnostic. It's something. And then they think the price going up justifies their bias, their theory in their head. But what's the danger about that is one day, let's say, there is a secular bear in US stocks and in real terms are turning down and the price of Bitcoin goes in a secular bear. And then it's going to conflict their ideology of it and they won't be able to sell and they're going to ride it sideways or down forever. Like, just follow the price, guys, for crying out loud. That's what aggravates me the most about when I hear this stuff. It's like people are confusing. They're confusing ideas and actual price action. So that's what I say, It's like, it's behaving like a duck. It's quacked like a duck for 10, 12 years. What is going to be different this time, But of course, there are some tech plays that did do okay during their bear market from 2001 to 2011. They didn't all track the NASDAQ. Some stuff did do better, but you would have done much better playing the commodities during that period,
Yes, maybe it can do okay and it will make new highs a couple times. I mean, I don't know, but I just don't see it having another spectacular move for the next 10 years. I just really struggle to see that.
Yes.
Well, one way we can be certain about that sort of theory really is to track the Bitcoin to gold ratio. So the Bitcoin to gold ratio chart, if Bitcoin's breaking out and is clearly leading, then we have to accept that for exactly what it is. So we treat the Bitcoin to gold ratio chart just like any other ratio chart, and that helps to put the bias to one side, I suppose. But I tend to agree that I have a little bit of a hard time envisaging the scenario where Bitcoin decouples completely from what it's been doing for the last 10 or more years, i.e., as you just said, following the NASDAQ and tech stocks. But this is now Bitcoin's chance to do that if we are entering the secular bear market for stocks and for tech stocks as well. And it's Bitcoin's chance to actually decouple and show that it's not going to follow
it's had its chance to decouple for 10 years. If it would have decoupled 10 years ago, its performance would have been awful. It would have been like the gold chart. You know what I mean? People are
Right.
saying, oh, it's going to decouple. No,
Yeah.
if you were
No,
gold,
but Pat,
you would have
Bitcoin
No,
is going to be
10
good
years
in
ago.
both
Yeah,
scenarios.
I have this. I have the same enthusiasm as you. I completely agree. And we'll get a snapshot of that whenever gold breaks above 2,100. I mean, assuming that's coming in the months ahead, and we'll see if gold breaks above 2,100 and your silver starts getting a bid. The silver goes back to 2,830, then it can break above that. During that period, we'll see how Bitcoin performs. And my guess is maybe it'll go up a little bit, but I just don't see it at that point. I don't see it just performing in line with gold and silver.
It is. I find it fascinating because, if you think about the amount of adoption that Bitcoin has had so far, and that, I don't really know anybody that uses Bitcoin for anything much apart from speculating, and even that is only probably about 2% of the people that I know, then the adoption is very low on a global scale, if my experience is to any kind of indication. So, from that point of view, and I'm going to mention fundamentals here, guys. I'm with you. I'm saying this really to be the devil's advocate, but ETFs, the halving, which is coming up next year, and all this kind of stuff. It's an argument, or it's a discussion, or it's a reason that a lot of people have on social media, and a lot of followers of cryptocurrencies, and particularly Bitcoin, I should be talking about specifically. And I can see those arguments, I can understand them, but I want to see that reflected on a technical price chart before I'm going to buy into it, obviously. But from an adoption point of view, if people say that ETFs are going to radically change the way Bitcoin becomes adopted, but don't forget that having an ETF works both ways as well. It doesn't just allow people to buy very easily. I mean, if that was the case, then we've got ETFs for gold, for crying out loud. So why is gold gone? So just having an ETF is not a reason on its own to send Bitcoin to 100,000, 200,000, or some ridiculous new highs. It needs more than that. It needs more than ETF. It needs more than a halving. And a halving, I've got to remind people, by the way, gold has a halving effectively because it has the same 4-year cycle as Bitcoin. So perhaps that cycle that Bitcoin's got is actually not particularly related to the halving, and perhaps it's just a normal cyclical behavior that most asset classes have. You can find 4-year cycles in many asset classes, 8-year cycles, 16-year cycles. So that in itself does not make Bitcoin unique. So that's just a reminder for people out there as well. So having the stories and the narratives, great, but it has to show on the technical price chart, and it has to show on the ratio charts as well. If Bitcoin can beat inflation, if it's beating the SPX and it's beating gold, great, I'm in Bitcoin. When those charts break out, they haven't yet. They haven't. And I was looking at these charts with Patrick earlier on as well, and they're getting closer, of course, but Bitcoin has not broken out versus the S&P yet. There's a very important trend line, breakout line, that needs to be overcome, and it hasn't done that yet. So when that happens, then just like anything else, and that's where the bias, removing the bias, comes in. If you're a technical chart trader, and Jordan, I think you'll agree with this, if you can use the charts to be completely objective about it and not subjective. That's my little moment on the soapbox there. But yeah, I mean, everyone's got their own techniques.
Yeah, one more thing I'd mention, because some people are comparing it to, I mean, there's one guy from Fidelity who is really good, and I think he's compared it to gold in the 70s. And so if Bitcoin follows that pattern, well, at some point it's going to have a 20-year bear market. So that's the other, I mean, that's one comparison. When gold, I mean, of course, the price is artificially low in the 60s. They had to let it go in 71. So 35, went up 25x, almost to 900. Then it did nothing for 20 years. So maybe at some point, Bitcoin and crypto is going to do nothing for 20 years. Like that's what could be ahead at some point.
And another interesting observation is that when you analyze the momentum on Bitcoin, that's clearly being lost. At each wave to the upside, momentum is being lost. You only have to look at the monthly and quarterly technical indicators, whether it's the MACD or the TRIX or the RSI or whichever indicator of your choice. The rate of change indicator is another very good one. At each cycle, at each new wave to the upside, there's less momentum there. It's making lower highs on those very long-term indicators. So there's something clearly going on there with Bitcoin, that each time it's making smaller percentage moves to the upside. Still impressive, but smaller, which is important.
Look, I want to, if I could circle back to, like Kevin mentioned, Bitcoin to SPX needs to break out. Let's go to the gold versus SPX, Jordan. I know you've been watching it. Now, do you have a line in the sand for gold versus SPX on that ratio, a level where you say, okay, once we're above that, headwinds have mostly converted to tailwinds and we're good to go?
Well, I think if we break above the I think it's 0.50
I'll share my
or
screen,
0,
guys.
yeah, go ahead. 0.51. I think that's what, 2.5 year, 3 year resistance. So
here.
that's the if you go back to that line, if we're looking at
You know what I'm gonna do? Hold on. I'm gonna do the whole the one that goes back all the way to the goodness, look at that chart. Yikes. Okay. Here, I have the chart since forever. .5. Yeah, .5.
Got
Around
5.1,
here.
I think you said, or yeah, it's close to 0.5, isn't it?
yeah,
That's
0.50.
Yeah, that sounds about right. Look, that was the bottom here in the 70s. That was the bottom. Well, gold had went down so much in the 2000s that it got above that level in 2007.
Are those quarterly
No,
closes?
those are monthly. Do you
Or
want me to put
monthly?
on the?
Okay.
You want me to go on the quarter?
No, that's fine. But yeah, I'm looking at daily and weekly data. Yeah, it's
I'll go. Hold on. I'll go on here on the weekly. Yeah, here, right about here on the weekly.
Also, to note on there, people seem to forget as well quite quickly that gold has been outperforming the S&P now for getting on for 2 years. So that's a start.
Well, yeah, I'm waiting for that line. I'm about here also, Jordan. There, once the momentum has gone flat for a while, then it's going to be easier to go up, right?
Also interesting to note that gold has broken, or perhaps I should say, the Dow Jones has broken down versus gold already. So the Dow to gold ratio.
That's a really good point. If you look at the other indices, and other stock markets, it has basically already broken out.
So this is the Dow versus gold. So it's the inverse.
Yeah, and you can see at 16, it's come when it breaks below 16.
That's right.
Yeah, it's an important horizontal level. Yeah.
Let me put my.
So yeah, I mean, I think if we do have a recession next year, it's going to break in gold's favor. And of course, at the same time, gold blowing through 2100. That's also that's also an important development, obviously.
Look at that thing, Kevin. It's a wedge below breakdown line. And the Russell, did you see the Russell so weak? Have you ever seen a bull era for US stocks where the Russell did not participate, Jordan?
No, can't say that I have.
Right?
And yeah, I mean, that's an important point, because we're looking at there's so many cracks in the market. I mean, this is supposed to be a recovery, and there's quite a few cracks.
That's the trend line. This was the peak in gold back in 2011. 1 touch, 2 touch, 3 touch. Well, look at, but there's support here, but it's not looking, we can't say it's looking great. There's a whole bunch of support levels everywhere, but it hasn't done a new high in forever. It's like, it's not until this line gets breached to the upside. The Russell in real terms has gone nowhere since 2013, for crying out loud. right? It's like it's gone nowhere for 10 years. It's gone nowhere.
Yep, and I keep reminding people that, you know, the stock market more generally, the S&P, Nasdaq, could be looking at, you know, anything between 15 and 20 years of going nowhere if previous history were to be repeated. And, you know, that is what eventually gets into the psyche of traders and investors. And that's exactly, you know, what feeds into bull markets elsewhere. You know, if you're wanting a return, you're not going to be sitting in something that's given you no return for the last 5 or 10 years, are you? So eventually, you know, people will start to react more and more to what's blatantly obvious. And, you know, it's really just a question of, you know, people actually beginning to believe the reality rather than the narrative. The narrative is so fixed in everybody's mind. Stock markets go up, stock markets go up.
Yeah.
Gold goes nowhere, commodities go down. It's been ground into people's psyche for year after year after year after year. But when there's a trend change like this, it's slow at first, and then it gathers momentum.
Two things to add on that. Like, Patrick, maybe you can look at a 100-year chart of the S&P, something like that. Just stop it in 1968. Like, look at, maybe you could chart the S&P and then just stop it in 1968. And then I think the turning point will be when gold breaks above 2100. I think that's when, because there's so many generalists who are waiting for that. Like, when you see gold breaking above 2100, if we get that next year, you know, we have gold breaking above 2100, and the, you know, I think it'll happen when the stock market's moving down, actually, to be honest. That's my sense.
Well,
that's going to be a huge development for people's psyche and a lot of capital, you know, when they see gold at, you know, 21 or 2200, and the, you know, the stock market is breaking down or not performing. But see if you can show a chart from like 1920 to 1969.
okay.
Something like that.
So here, these are all the recessions. I could remove that there, or I could leave them on.
Yeah, I mean, if you just look at that, you know, and just think about in 1969 or 1968, maybe you could chop off that, that last. Just think about what people were probably thinking about in 1968.
The Nifty 50 to the moon.
Yeah, right there. Cut it off.
I know
right
what my
there.
parents were thinking about. I was born in '69.
Look at that.
Yeah, if you cut it off, like, right, I mean, look at the people that was, wow, look at this market. It's gone up for almost 30 years. I mean, this, you know, you have to invest in stocks for the long run, you know, blah, blah, blah. I mean, if you think about what the psyche was at that point in 1968, you know, how the market had performed
like this
in the last 25 years.
Yeah. That's what you'd expect here. But they're not looking at the ratio charts probably, because you would probably see the underlying weakness of S&P versus oil, S&P versus silver, you know. It's
at that point, no one was thinking, oh, we're going to see, you know, more inflation, or we're going to have the markets going to do nothing for 15 years.
And what's even more intriguing than that is, even after that trend line breaks, people do not take notice straight away. It's not an instantaneous thing. The technical chart analysts will see the chart breaking down. They'll see the supporting evidence. They'll see what's happening in other markets and the ratio charts, and react, you know, pretty early. I would have thought, but you know, a lot of people here still just not really believing what they're seeing. It takes years. Surprising, it takes years for the general public to really start to, or general investing sort of public to really realize what's going on.
And like I said, the beginning of that shift in general psychology will be gold breaking above 2100.
Yes.
But that's only the beginning.
Every time there's a move up and a rally here, you know, you'd be getting cries of, oh, you know, everything's back to normal again. You know, stocks are great. Look at that, you know, quite a decent rally there.
The rally is going to be crazy. I'll show you something. Okay, this is the rally. The rally is going to go do all-time new highs. But if you would have been looking at, I'm going to let it play out. I'm going to add the SPX divided by CPI or PPI. Let's do a PPI. In real terms, check this out. This is kind of cool. Look, so here I have in PPI, gold, the market in here. See, it's doing new high, breaking out. But look versus PPI, what it's doing. The overbearing inflation is showing you the real, in real terms, the weakness. It's not doing new highs here. While this nominally, people think, oh, we're in a new bull era. But you cannot have a new bull era in U.S. growth stocks if you're not outperforming inflation. You're just not. You don't have the tailwinds you need. And look what happens. Eventually, it just sucks it down, breaks down versus PPI, breaks, and after that, nominally, then you get the sell-off, and that was the end of the rally.
And you also can't, you can't have it when gold has made a new all-time high recently.
Exactly.
So that's the
look. Yes. You see that? So it's leading. So that's why the gold to the SPX to gold ratio is crucial, because even if both instruments are going up, if gold's going up faster than SPX, that's the market telling you capital flows are not favoring SPX as much, and they're vulnerable for rug pulls.
Yeah, there will be points when the two go up together. I mean, yes. You do see that. You look at, and because I always make the points, the stock market has to, it has to fall below the 40-month. It has to be in a secular bear for gold to go up. And sometimes people say, oh, well, look at 2002 to 2007. I mean, they both went up together. Yeah, I mean, there's points in the 70s where it happened for a year or two. I mean, even the 1930s, after 1931, 32, the gold stocks had the spectacular move when the stock market recovered. So there will be, in the coming year, after we get this recession and, resumption of this bear market in stocks, then you get the next rebound, the market will recover. But that could be a point when the two are actually going up together. So there will be points where the two are moving up together. But yes, it's so important to focus on the secular big picture where, gold's broken out to a new all-time high. Stock market has lost its 40-month moving average. Gold to the S&P ratio is strong. It's, making 2, 3, 4-year highs. I mean, you have to, it's so important to look at those things and, understand what the big picture is, because I do get that occasion. Well, I mean, look at, 2004 or 2005. I mean, they both went up. So that will happen. But I mean, you guys are focused on these secular big picture things, which are so important.
That's right.
Well, they are, because if you are aware of the secular big picture, then you're always going to be able to know where the headwinds and tailwinds are. So, if you're wanting to make a trade or an investment, you're instantly going to be increasing your odds and chances of success. Because if you're trading or investing in the right environment, if you're shorting in a bear market or going long in a bull market, then yeah, it doesn't work out every time. Of course it doesn't, but your odds of success increase pretty dramatically. So that big picture awareness is key. You need to start with the forest, and then look at the individual tree, forest to tree approach, and it's just like reading a map. You start with a big picture, and then you zoom in on the little bits of the detail. So yeah, I think you're exactly right with that.
Good stuff.
Yeah,
Jordan.
and again, I'll say, the important takeaway for people, also the significance of the bond bear market, which started before you had the secular bear in the S&P in 1969. So that's another important development in the last year that, people need to understand the importance of that development and how that plays into, these new trends where you have secular bear in stocks. I mean, that because the secular bear in bonds can cause, or it will cause eventually, a secular bear in stocks. My buddy Vince Lancy, who I interview frequently, he says, eventually, the interest rates went out, meaning eventually high, the bond bear market and higher bond yields, eventually that wins out over the stock market. And that's what happened in the 1960s, and we're seeing that again. We've probably seen the start of it,
because it's guaranteed fixed income. Eventually, oh, I have 6% guaranteed. if I'm a huge hedge fund, like, you know, it's like pension funds, eventually, man, look, I have to log that in.
Yeah.
I have to lock it in.
People with extremely high net worths, that's a shit ton of money. I mean, if you're putting 10% and you're earning, or you have 10 million and you're getting 5 or 6% off that, you don't need to do anything. You're not going to invest in the stock market.
Yeah, to get 8% but to get marginal better returns, but with way more risk, you know. You know, it's like companies go bankrupt, stuff, you know, it's not, you know, you're not going to get a rug pull.
Right.
The yield's guaranteed, right? You buy that and it's done. It's like, that's what you're going to get.
Right. And it's
I mean, to an
and-
extent, this is kind of self-reinforcing as well, because higher bond yields, you know, I'm thinking here about the sort of dynamics of the debt markets and the national debt and debt sustainability, debt repayments. You know, we're seeing national debt in the US, I think north of 30, is it 33 trillion at the moment? Annual payments of around about $1 trillion or so. You know, these are big numbers, and they're going in an ever upwards direction. So that in itself is, you know, inflationary. It's that in itself is a problem. Whether it becomes a major problem at some point or another, whether it's entirely sustainable for the, you know, indefinite future, I suppose we're about to find out over the next 10 years or so. But you know, we saw the same dynamics in terms of the bond market in the 1970s, but the debt to GDP ratio was very different, of course, because the debt to GDP was falling and fell from, I'm trying to remember the numbers now, but it fell down, you know, the debt to GDP fell to about 30%, I think, from wherever it was to the peak in 1980. So you had debt to GDP going down substantially.
It did. Yeah, I think it didn't start.
And it's quite the opposite now.
I want to say 1946 or something like
Yeah.
that. And somewhere in there is when they finally got it under control. But that's I mean, you need a lot of inflation for that to get under control. And so we will see yield curve control at some point, probably in the next few years.
Goodness.
Yeah, the yield curve inversion has been interesting to watch as well, and I think it's the market sniper I've been keeping an eye on as well. He's very much on top of this, and you know, that when that yield curve uninverts and the 10-year yield minus the 2-year yield starts to move back towards positive territory, that historically has not been a good thing for the markets. And you know, we've been negative for quite a long period of time now. I think probably just about the longest it's been negative for the last 100 years. I think it's something like 18 months, if my memory serves me. But that 10-year yield minus the 2-year yield is gradually working its way back towards that zero line. And every time that's happened in the past, it's not had a good result in terms of resulting in things like the financial crisis, and you've got the Asian market crisis, you've got the dot-com bubble, you've got all sorts of nasty events that have occurred historically when that yield curve uninverts. So again, those sort of dynamics are fascinating to watch play out, and they all point towards what, you know, the scenario that you're talking about there as well. So it all kind of fits together like the pieces of an unpleasant jigsaw puzzle once you start to look at that big picture.
Kevin, I thought everything went to the moon nonstop. I'm a baby millennial, whatever you called it there. Stock market always goes up. That's how old we are, Jordan. Like when I started, when I was 23, I saw the dot-com bubble. I saw guys at work that were planning their retirement. They were so rich on Nortel and all these companies that don't exist anymore. And they were all talking retirement in 2001. And then when I started trading in 2006, I saw the 2008. But how many people now have never seen 2008, right? We're so deep into a secular bull in stock markets. I'm sure a lot of new traders have not traded the 2008 crisis.
A secular bull, they've only seen a secular bull in bonds. Think about that. You know, the 40-year, 43-year, where I mean,
over 40 years.
Yeah. I mean, that's a huge, I mean, that and like a major inflationary cycle. I mean, that's a huge sea change. Like very few people who are on Wall Street have experienced that. I mean, if someone will, let's just say 20, if they were, I mean, they probably would have had to have been born in what, 1945 maybe, or 1940.
Goodness.
You know, maybe even 1950. So yeah, I mean, it's even someone who's 55 or 60 who's on Wall Street, they haven't seen a bond bear market.
No.
But
And that's
isn't
why
there
that's
this?
why it's all the harder to accept it.
Yes, and
Okay.
that only charts. That's why you need a 100-year chart, because you'll never see those cycles if you don't have
Yes.
a
Yes.
whatever. And I'll-
Yes. You're absolutely right. I mean, when I look at this stuff, I love looking at 100-year charts. I mean, it's look, you know, sometimes I try and get historical data for certain things, and yeah, you can get 3 years or 5 years. I mean, that's meaningless. That's, you know, you need to look at 100 years. Give me the whole history.
I'll tell you one thing about what resonates with what that we're close to the 1970s again is I did an analysis on wages, and the rate of change for wages, the how much the 7-year rate of change for wages right now is at the same angle of ascent we had in the 70s. It's even steeper. So that when the wages start piling on, it's confirming that whatever self-fulfilling prophecy, because now it's anchoring, you know, it's like lockstep, right? It's just
Right.
and we didn't have that ascent in wages back in the 2000s in the bull cycle for precious metals. We did not have that.
Absolutely right. We're getting pay settlements here in the UK between sort of 7 and 10% in many cases. Well, that's locked in a whole load of inflation for the next year or two, isn't it? Because people have got 10% more in their pockets. That's going to it's just simple logic, you know. So it's that wage price spiral that, you know, we were told wasn't going to happen, that we were told we were going to avoid, and certainly the government here in the UK said it's not going to happen. That's not a thing. Well, I'm sorry, guys, but you know, when that 10-year yield chart had that false breakdown around the time of I think it was around the time of the COVID pandemic, and it broke down below that channel. At that point there, it was screamingly obvious that bullish descending wedge was going to take interest rates and yields up to the levels that we're at now. So we are clearly, in my view anyway, clearly in a new paradigm, a new era, a new backdrop for trading and investing. And there's no getting away from that, even if they cool off and come back down to 2.5 or 3% on the 10-year yield. It's not,
guys,
it doesn't change anything.
We've been talking for almost an hour, man. I don't want to take too
Yeah, I
much.
could talk for another hour here, Pat.
It's fun with
I actually, yeah, I got another call here in a couple minutes, so I got to run. I was
Well,
trying to
first tell
say
me-
that without disrupting the interview, but yeah, you can cut this part out if you want.
No, it's all good. I don't mind. Just tell everybody where
Okay.
they could find your stuff, Jordan, before we say bye.
thedailygold.com. You also check out my YouTube channel, The Daily Gold.
Yes.
So yeah,
please, guys,
thedailygold.com.
go check out all Jordan's stuff. It's brilliant stuff, man. Unsung hero of the technical analysis and all that macro stuff. You're great, Jordan. Thanks for your time. I appreciate it. Have fun on your next interview.
Thanks for having me
Thanks,
on,
Jordan.
guys. It was a real pleasure.
All right. Bye, Jordan.
Appreciate it. Bye-bye.
Bye-bye.
Please subscribe, like, and hit that notification bell. Thanks, guys.